You can buy two different funds that hold the exact same stocks, like an S&P 500 fund, and you'd probably think, hey, my returns should be pretty much identical, right? Well, not so fast. It turns out the wrapper these stocks come in, whether it's an ETF or a mutual fund, has these hidden mechanics that can actually lead to some surprisingly different results for your money. Okay, let's really dive into this with a scenario. Imagine this. You put your money into an S&P 500 ETF. Your neighbor, right next door, puts the same exact amount into an S&P 500 mutual fund. Fast forward a few years, you're chatting, comparing notes, and you realize one of you has noticeably more money. But the market did the same thing for both of you. How is that possible? Well, the answer is the hidden story we're going to unpack today. All right, let's bring our two contenders into the ring and see how this all works. On one side, you've got the original, the trusted OG, the mutual fund, which has been around since, get this, 1924. And on the other side, we have the modern challenger, the exchange-traded fund, or ETF, which didn't even show up until 1993. Now, the first difference you'll notice, the most obvious one, is just how they trade. A mutual fund, it only gets priced and traded once a day, right at the end. That's it. But an ETF is a totally different beast. It trades all day long on a stock exchange, just like a share of Apple or Microsoft, with its price bouncing around every second. And this table here really breaks down that core difference. See, with the mutual fund, all the buy and sell orders for the day get tossed into one big pile. Then, after the market closes, they're all executed at one single price, the net asset value. With an ETF, though, if you hit buy, your trade happens instantly, right then and there at whatever the market price is at that very moment. It's all about supply and demand in real time. But honestly, how they trade, that's just the warm-up act. The real story, the thing that explains that difference in returns between you and your neighbor, happens behind the scenes. It's all about what goes on when people decide to sell their shares and get their money back. So here it is, the big reveal. When you sell a mutual fund, the fund manager has to literally go and sell stocks from the portfolio to get cash to pay you. And if those stocks have gone up in value, boom, that creates a taxable capital gain that gets passed on to all the investors who are still in the fund. ETFs, though, have this incredibly clever workaround. A huge financial institution just swaps your ETF shares for the actual stocks themselves. It's a barter, really. It's called an in-kind redemption. And the key part, no cash sale means no taxable event for the fund. Now, you're probably wondering, who does this swapping? Well, that brings us to this special middleman, the authorized participant, or AP. Think of them as the wizards behind the curtain. They are the only ones who can perform those in-kind swaps directly with the ETF. They are literally the engine that makes this whole tax-efficient system go. This whole process is also how an ETF's price stays honest all day. If the ETF shares start to get a little too expensive compared to the actual stocks they hold, an AP jumps in. They'll buy the cheaper stocks on the open market and swap them for new, more valuable ETF shares, which they can then sell for a tiny, risk-free profit. This action adds more ETF shares to the market, pushing the price back down. It's a brilliant self-correcting system, all driven by profit. Okay, so we've been talking about these in-kind mechanisms and APs. Why does all this complex plumbing matter to you? Well, because it creates one of the biggest and frankly one of the least known advantages in all of modern investing. We're talking about a massive difference in tax efficiency. I mean, just look at these numbers. They are absolutely staggering. In 2024, nearly 2/3, almost 65% of all equity mutual funds had to pass on a tax bill to their shareholders. And for equity ETFs, just over 5%. It is a night and day difference. It's not even close. And we're not talking about a small rounding error here. That extra 1%, maybe even 1.5% in after-tax returns compounded over decades, that can be worth way more to you than saving a tiny bit on a management fee. This hidden benefit even has a name. They call it tax alpha. And for anyone investing in a regular brokerage account, it is a huge, huge deal. But just when you think the advantage couldn't possibly get any bigger, it turns out ETFs have another level to their tax scrubbing power. Seriously, it's a maneuver that sounds like it was pulled straight out of a financial thriller movie. It's called a heartbeat trade, and it gets that name because if you look at a chart of the fund's flows, you see this massive in and out blip that looks just like a heartbeat on a monitor. It is an incredibly sophisticated technique that fund managers use to essentially wash their portfolio clean of the stocks that have the biggest built-in taxable gains. So here's how this magic trick works. An AP sends a massive amount of money into the fund to create a ton of new shares. Then, maybe a day or two later, that same AP redeems all those shares. But, and here's the clever part, instead of getting a normal slice of the fund, the manager gives them a custom basket filled only with the stocks that have the biggest taxable gains. This lets the fund purge those gains from its books tax-free for all the investors who stick around. It's an unbelievably powerful tool that a mutual fund just can't use. So, for decades, this superior structure was the ETF's secret weapon, its key competitive advantage. But this story has a major plot twist. A series of recent events has completely changed the game. You might have wondered why Vanguard's mutual funds were always just as tax efficient as its ETFs. Well, this was their secret weapon. For over 20 years, they held a patent that let them bolt an ETF share class right onto their existing mutual funds. So those in-kind redemptions from the ETF side would scrub the capital gains out of the entire shared portfolio, which meant the mutual fund investors got all the same tax benefit. But as you can see from this timeline, that exclusive party is over. The first domino fell when Vanguard's patent finally expired in May 2023. Then, in late 2025, the SEC gave the whole industry a green light with something called the Dimensional Order, which basically created a public roadmap for any fund company to adopt the superior hybrid structure. The floodgates are officially open, and now everyone is racing to combine the best of both worlds. Okay, so the entire industry is converging, that's clear. But right now, today, the choice still really matters. So with everything we've talked about, how do you make the right call for your own money, for your portfolio? Well, the key takeaway here is pretty simple. It all depends on where you're investing. For a regular taxable brokerage account, the ETF is the hands-down winner, thanks to that amazing tax efficiency. But for a retirement account, like an IRA or a 401k, where the taxes on your gains are already deferred, a simple index mutual fund is often a perfectly good choice. And honestly, sometimes it's even easier if you want to set up those automatic recurring investments. All right, so let's just quickly recap the big ideas to take away from all this. First, the wrapper matters just as much as what's inside it. Second, those in-kind redemptions, that's the ETF's tax efficiency superpower. The rule of thumb, ETFs for taxable accounts, mutual funds for retirement accounts. And finally, and maybe most importantly, this whole landscape is changing, and that gap between the two is closing fast. And that brings us to our final thought for the day. Now that the secret's out and the whole industry can adopt this new, more efficient hybrid structure that Vanguard pioneered, are we actually witnessing the beginning of the end for the classic standalone mutual fund? It's a fascinating question, and the answer is going to reshape investing for all of us for decades to come.